what episode are we on now? I don't know, 11 maybe? Anyway, right, we're starting off with Coty, C-O-T-Y. I think that's how it's pronounced. I wouldn't have a clue, but this is something that I came across while on a lunch break at work today. Having to be a bit quiet while recording this because once again it's well gone midnight while I'm recording it. But I thought it was a bit of an interesting one to dig into just because of the names of the brands that this company owns, and then the stock price is currently, in the gutter. Although today it's, what's it grown today? 20%, 15, 17% in a day. So, but historically, look, we are way down where we are now. It's 70% drop-ish. So for those of you who don't know, I came across Coty on Insider Buy-In because it's significant, like 1.2 million, around about 1.2 million in the last, what date are we today? So it's the 29th while I'm recording this. So last 3 days, 1.2 million has been bought now. This is saying that it's a purchase, not an option trade, not exercising options or whatever. So potentially a legitimate purchase. If we go on their SEC page and just check that a minute before we go too deep, because, I say before we go too deep, I've already done some research into this, but Form 4 is also saying P for purchase code, which means it should be an open market purchase, which obviously has a lot more weight if they're actually spending their own money on purchasing this stuff. So let's get a 10k back up a minute. But I came across this on break and I chucked it in the quick take spreadsheet, and I was like, this, to be honest, this doesn't look great, does it? Like 13 years to purchase a company on market cap, 30 years to purchase it on EV. Because look at the difference between market cap and EV. It's huge. Some bad years early on. Return on capital was not great. We've looked at businesses that are better than that, but the brands that they own are phenomenally big brands. So I thought it would just be an interesting one to look into, because there'd probably be a lot of intangible, what do you call it, intangible worth to their assets on this, just because of the brand names that they own. But generally I'm not bothered by intangible assets. I think that's probably been pretty clear from most of my videos. But simple free cash flow is not bad, 300 million, close-ish, it's certainly declining, but then I'm not sure that that's unexpected, considering the state of a lot of people's economies at the moment. Ours in this country is dog shit, so people are not buying luxury brands. But yeah, so I pulled this one up anyway. I've put it into the spreadsheet already, and while I was at work, I made a few simple notes on what I was seeing. So for those of you who don't know, I've already asked ChatGPT a lot of these questions, so we're just end up going down through. This is a good thing about ChatGPT, is it will save your conversations, and then you can just go back to them. But Coty's business model, how it makes money, business segments, and its geography of business. Product sales primarily from fragrances, colour cosmetics, skincare, nail and body care, and hair care. They also have license agreements with other big brands like Gucci, Burberry, and Calvin Klein, which pay royalties or revenue shares, and then they sell through multiple channels: department stores, e-commerce, mass market, salon professionals, third-party distributors. So they've invested heavily in brand marketing, TV. You would have seen a lot of these businesses on TV and adverts and whatnot. So their consumer beauty market is hair care, body care, color cosmetics. Don't really know what that means, but I'm guessing like hair dyes or something. I don't know. Fragrances. So big box retailers under brands like Rimmel, think I've heard of Sally Hansen, I don't know, but they target high income consumers, and I think this is possibly where they're falling down at the moment, because a lot of people ain't spending money like they were. But online channels brands include Gucci, Burberry, Calvin Klein, Tiffany & Co. Like, I think most of those are licensed brands if we actually go further down into it. But they've also got a professional beauty side of it, which focuses on products for, you know, like hairdressers and all that sort of stuff. Very global, 130 to 150, 130 to 150 countries worldwide. A mix of wholly owned subsidiaries and third-party distributors. Hasn't actually got I don't believe I actually asked for a country-by-country breakdown, did I? A revenue breakdown last quarter was 55% fragrance, 30% color cosmetics, very little in the hair department, skin, beauty. Geography, 42% is in America, 47% is in Latin America. 42% is in USA and Latin America, 47% in Europe, so slightly bigger in Europe, 11% in Asia Pacific. It'd be interesting to actually ask where the growth is in that. So yeah, got quite a few avenues to make money here. The biggest problem is that they ain't doing particularly well. The share price is obviously proof of the pudding and that. Yeah, let's see if I can find. So I said here, like, do they make products for designer brands or do they sell licensed products for them? So they do have licensing agreements. It obtains licenses from fashion houses like Gucci, Burberry, you know, the ones that was named previously, which I thought was correct. Somewhere here it does say, so when they do stuff for these brands, Coty is actually the people that are responsible for designing, producing, marketing, and distributing the products. So effectively, they are the workhorse, and the brand is just putting their name to their work. So Gucci itself doesn't manufacture its perfumes, Coty does under Gucci's brand name, and they get approved by Gucci. So revenue models is Coty pays royalties or revenue share to the designer brand by keeping the bulk of the product sales revenue, which is quite interesting. But where are they? Own brands like Rimmel, Sally Hansen. I'm sure I had a list. Here we go. So Coty owns outright CoverGirl, Rimmel London, Max Factor, Bourjois, Adidas Body Care. So there's acquired rights there, but that may potentially that means that they're the only ones that have those rights. I don't really know. But some pretty, at least in this country, Rimmel, Max Factor, they're quite big brands. Most people would have heard of them, or most people would have seen on TV adverts for them, you know, and then the people that they're licensed for are also huge brand names, which also states as well that they would keep the bulk of the profits for creating these products, which is, I thought, quite an interesting thing. So if you're buying lipstick or Sally Hansen nail polish, CoverGirl lipstick, that's Coty's own brand. If you're buying Gucci perfume or Burberry, that's a product made by Coty under license from the fashion house. So sort of a bit of I'm sure it's not an uncommon business model, but it's reasonably interesting considering big brands. I don't know nothing about the fashion industry. I'm an engineer, I wear jeans and a t-shirt, and I pretty much wear the same colour all the time. But yeah, I found it reasonably interesting, at least, that brands like Gucci and all that, basically they have no input other than, we want you to make something that smells like this, that smells nice, sell it, and then we'll take a profit from it because we're the people who've got the name, you know. So I then dragged up the financials, and the financials are I wouldn't even know how to explain it, so we'll just go through it. They're 6 of one, half and a dozen of the other, really, in that, you know, revenues are not, well, they've declined quite a bit. They obviously had a very good period in 2017, 2018, even in 2019, but since then they've sort of declined, built up a bit last year and again have dropped slightly. But over the last few years, you know, if you consider that 2021 would have been hit heavily with COVID, you know, they're reasonably consistent in their revenues, so not the end of the world. Gross margin has slowly increased, which is obviously a good thing. And SG&A margin has slowly decreased, which is obviously another good thing. You know, if you can make more money from your products, and then you can pay people less to make more money, obviously that's good for the business. You know, operating margin, this is where it starts to get a bit lumpy, really, in that your operating margin and your simple free cash flow margin, they're a bit all over the place, you know, negative, they're very lumpy. It would be very difficult, at least for me with my inexperience level, to normalize any earnings off of that, you know, in that one year they're 1%, one year they're 5%, sometimes they're negative. Like how would you normalize earnings off of that? I don't have the experience yet to you know, to go, well, this is obviously normal earnings, like, because it's too lumpy for me and my experience level at the moment. But one of the other things I noted is that book value is not steadily, it has steadily declined, because that's over a number of years, but it's still quite a drop from, you know, like mid-13s down to mid-4s. The only positive thing I can see from the decline in book value is actually the tangible book value is increasing. So, you know, I rate tangible book value more than book value, purely because, as is the name, it's tangible. You know, like the fact that you've overpaid for something with goodwill, like, that's, how can I put a value on that? You know, you've overpaid. And in a minute we'll see with Coty examples of themselves getting themselves into trouble by doing just that. But interest coverage ratio is something that I've recently become quite big on. They've had a few really tough periods with interest coverage ratio. Like, I'm not sure why that one's not red, to be honest, because that 0.5, it means that they can only afford half the interest on that year. This is done from simple free cash flow, but if we go down to the interest TTM, interest expense 227 million, that is, or simple free cash flow TTM at the moment, at least by my calculation, is only 600,000 higher than that. So really at the moment they can, by my simple free cash flow calculations, they're really cutting fine on whether or not they'll actually be able to afford the interest expense this year. The cost of debt has declined slightly, in that they're, you know, revenue. We're going back to the revenues here. The revenues per share is reasonably consistent over the last few years. The return on capital down here, so the metrics I'm quite big on is return on capital, which is this is Joel Greenblatts formula from his actually from his magic formula, but it's very, very, very similar to Lee Lu's deployed capital, and I do it from EBIT, so that's unlevered cash flows, and I do it from simple free cash flow, so that's effectively exactly the same formula, but it's using EBIT or simple free cash flow. Now, in recent years, it didn't look too bad, at least on EBIT, but it's dropped, you know, significantly. Still positive though compared to what it was. So, you know, like I said, my problem here is that I'm finding it very difficult to normalize earnings on something that is so lumpy for my experience level. Now, the multiples as well are sort of all over the place for simple free cash flow multiple to market cap or to EV. I don't really know what to say about that, to be honest, in that if I looked across that, all of that, then at a maximum, I would give I know they're trading historically higher than that, but at a maximum, I would only rate, do a multiple for future free cash flow, probably about 10. Just my reasons for that are, it's so lumpy that I'm not good enough yet to normalize that, and the debt is huge. Like, to be willing to pay a large multiple for something when the debt is huge and potentially a problem. This is going to be potentially a problem, because that's what we're going to get to next. Because if we look at the total debt down, where is it here? Like 4 billion is quite a lot. Now it has come down significantly. In 2020, it was up over 8 billion. So they're managing the debt. It's not, it's not something that they're willingly let get out of hand. The only issue is when we actually look at the debt. So if we bring up the filings, financial statements, notes to financial statement, that's what we want. Go down to the debt. Now they've got early next year as well, 1.2 billion maturing next year. Now currently, if we look at what we've got here, cash on the books is 250 million. Simple free cash flow TTM 220 million, of which they've got to pay pretty much exactly the same in interest expense. So there's no feasible way, at least in my mind, that they're gonna cover that maturity with any of the money that they've got. It's something that's not going to be possible. So I thought, well, that's a bit of a red flag. That for me, not just a bit of a red flag, that's potentially a huge problem. So I've gone on, I'll have to draw this up on FINRA because I haven't done it on this computer yet, but this is what I was doing at work. You type in, wrong button, type in Coty and bring up their bonds. I was expecting them to be in the gutter. The 2026s, there we go, maturity dates 2026. I was expecting these to be in the gutter because they can't afford them. There's no way that they can afford them. And yet you go over and they're basically all trading at par, which baffled me a little bit, to be honest. So I then had to go to ChatGPT. My next question was, how are the Coty's bonds so well priced when they don't have the money to service maturity? And ChatGPT is like, it is a highly levered thing. Yes, bonds trade at surprisingly strong levels compared to what you expect from its balance sheet, which is, yes, true. At least I think so, So ChatGPT's come back with actually some reasonably logical answers, which is one of the reasons why I do like ChatGPT. Coty rarely intends to pay off big bonds maturities and cash on hand. Instead, it refinances maturities. Now, I'm sure it was Howard Marks that stated that less companies go bankrupt than you think, and more of them are able to refinance than you think. So the debt that seems like it's a problem can be pushed down the road, and sometimes it can be, a chunk can be taken out of it while doing it. Well, this is what ChatGPT is saying. What Coty does. As long as Coty's ongoing market access and stable demand for its products, bondholders assume the rollover risk is manageable, which must be happening because par value $100. They are effectively all at $100, and yet there's no way that they're going to afford the maturity on 1.2 billion in bonds. So the assumption has to be from the market that it's just going to get refinanced, which can sometimes, at least in my mind, be a dangerous assumption. But if that is what is seemingly going on, then that's what we're dealing with. So they're saying strong cash flows from fragrance and licensing. So the free cash flow is not bad, is it? What was it, 200 million a year? The cash in hand that you're left with is not bad. And their fragrance business, which is apparently 55 to 60% of their revenue, is the high margin side of it, global and relatively resilient, which, yes, I would agree with, providing the majority of people can afford luxury items. So because of the high margin, they're saying that it gives bondholders confidence that interest payments will be covered, even if the net profits are lumpy, and they are lumpy. Servicing interest is more important in the near term, fully repaying principal, which is true, I would say, in from everything that I've read, like Joel Greenblatt and all that. They want to know that you can pay the interest. They don't necessarily want to know that you can pay the maturity. So from that perspective, we're almost certainly looking at a refinancing that the market's pricing in is just given at this rate for the bonds to be that high. So Coty owns portfolios of highly valuable brands, which we have mentioned. They are Rimmel, and they've also got licenses, exclusive licenses as well. So it's a big deal, These licensing deals and brands are seen as collateral-like assets if Coty are in distress or restructuring and would likely preserve value for creditors. Now, bondholders bet that Coty won't be let go easily because designer houses also rely on them for fragrance sales. So what they're saying there is that they've almost got a safety net in that these brands are so reliant on this company that this company can't be allowed to go bust effectively. That's the way that I read that. It's almost like for this this line of work, it's almost like a too big to fail effectively, is what I'm reading into that. Now, that's never the case. I don't think that's ever the case. I don't think that should ever be the case. Everything can fail, but the perception is that it's not too big to fail, but it's going to be something that we need to try and keep going because of the impact it's going to have on everything else if it goes. So its shareholder base, apparently JAB Holding Company, large European family office, has also apparently historically stepped in to support them, which gives creditors confidence that maturities can be bridged. So that also helps bond prices stay higher because people believe that there will be someone there to step in as well to help them. Low interest rates and strong demand for consumer staple debt have compressed yields even as rates rise. Coty's bonds benefited from confident, that's just the market context of it, really. Perception of global diversification, which is true. 130 plus countries. You should be. And this is a global financial crisis. Your whole business shouldn't be affected in one go. If it goes tits up. Coty's bonds being well priced doesn't mean the company could repay maturities purely from cash flow. It means that the market is betting Coty will refinance successfully, backed by strong brand assets, stable fragrance demand, and support. So if Coty ever lost market access or JAB support, then it could turn very quickly. I'm sure it says somewhere that they've never must be on the next question. So I said, well, what is the history of refinancing them? Or this is where the bit we were talking about earlier, and when I said I'd come back to this, I think I was talking about goodwill. Now, in 2016, Coty took on all of Procter & Gamble's beauty brands, CoverGirl, Max Factor, Ovella. That was funded largely through a new bond issuance, and this instantly put a huge a huge amount of debt on the balance sheet, which if we go to, does this one go back to 2016? Let's see, 2016, 2017. So let's do it on this because it's easier than total debt. Yeah, so there you go, 3 billion, just like that, boom. So they purchased all of Procter & Gamble's beauty segments. Now, 7 billion, took on 7 billion of debt to acquire Procter & Gamble's beauty brands. Now, that's a large amount of debt to take on, and we will see here, just 4 years later, yes, COVID ruined a lot of people, but just 4 years later, one of these brands that they'd spent 7.5 billion on purchasing, they had to sell a majority stake in it, and had to use some of that money to pay down its debt. Now, to me, that sort of reeks of bad management, in that you bought something that you clearly can't afford and you've had to sell it within 4 years. Imagine thinking, oh, look at these brands, we're going to buy them, it's going to be great for us. And then within 4 years, which is like a blink of an eye, really, in a large company's timescale, in 4 years, you've had to sell majority stake in one of the potentially biggest names on your sheet. I think that's a bit ridiculous, to be honest. To me, that's like, what? That wasn't really thought through, that purchase. That's just another example of overpaying for something and then literally having to sell it again. Like, there we go. To me, like I said, that just reeks a bit of bad management, but it is what it is. I know COVID obviously crushed everybody, all right? So, potentially if COVID hadn't happened, I don't know, because what were the revenue drops during COVID? 1.7 billion. It's, I suppose, down from 8. I guess it's significant, and they've not recovered since. So that's almost saying something on its own. So they've done some reasonably good refinancing, though. 4 billion in debt at lower coupons in 21, 22. S&P and Moody's noted gradual improvement, though still sub-investment grade bonds. So if we actually go on the grades are all, B's effectively. So I believe investment grade bonds are all A's. I could be wrong there. Don't take that for granted, but I believe that is the case. So currently they're saying that they're going to further deleverage with free cash flow, but with free cash flow, TTM is basically just enough to cover the interest expense. So we'll see where that goes. They're basically, I believe, going to have, there we go, down here, just the next bit. They're basically going to be forced to sell something, I think. You're going to have to get refinancing and be forced to sell something. It says here that, so Coty has never repaid major bond maturities entirely from free cash flow. So that's what I was mentioning earlier. I knew that I'd read it somewhere. Never repaid major bonds. So if they've never done that, then the market's going to be pricing in either an asset sale or it's going to be pricing in refinancing. They've rolled maturities forwards, refinancing, raised capital through asset sales, and they've also relied on shareholder backing. The track record explains why bondholders are comfortable. Coty has always found a way to refinance rather than default, even in tough markets. So it's a serial refinancer supported by valuable brands and strategic investors. Its debt profile has been reshaped multiple times since 2016. Maturity extensions, partial delevering, but it still all depends on access and asset flexibility. So I've then said, like, well, okay, fair enough. Some of it makes sense, but they're potentially almost certainly just about to make their company smaller again, which to me means that the 2016 acquisitions again were stupid. That's just my opinion on that. Like, to massively, over leverage your balance sheet to purchase something that you then have to sell, to me is just like an admittance that you made a mistake. But it is what it is. They were big brands, and I can understand why you would want them on, you would want their names on your sheets, but it seems to have backfired. Have they issued any forward guidance, was my next question. So they're saying they're expecting a decline for Q1, Q2, but in the second half they anticipate returning to positive sales growth. Now that, to me, is going to remain to be seen, because the UK and Europe, I don't believe that our economies are particularly healthy at the moment. I don't believe they're on the up. So if the majority of your sales are in a place where everything currently seems quite stressed, you can anticipate a return to positive sales growth, but I don't know that it's going to happen. People, at least in the UK at the moment, it doesn't seem seems to have the expendable, capital for large, expensive luxury items. Let's put it that way. But they're only they only reported a 2% year-over-year drop. So, but obviously mine's TTM, so mine's not come out with that because I believe actually we're on Q4, so the TTM should not make any difference. So I got a 3.68% drop in revenue from the data given from White Sheets, which is slightly different to what ChatGPT's been given out anyway. So Coty's forward guidance reveals cautious outlook heading into financial year 2026. Continued weakness through the first half, likely tied to macroeconomic pressures, which is what I was just talking about. Inventories and softness in both prestige and mass beauty categories. So effectively, like I said, people haven't got the money for purchasing luxury items. Effectively, they are positioning for recovery and growth in the second half. To me, a lot of that will have to come from the US, but that's just my opinion. So I want to read this actually because this article came up. I did ask just as we're going here because it's on the screen. I did ask about whether or not the insider purchases were open market or simply exercising options. Well, this here tells you the codes on the transaction form for P is purchase in the open market, which is what you want to see. You want to see that the owners are actually using their own money as opposed to money that they've been, effectively given by the company. It's like when they give them options, don't they? It's like an extra wage packet, effectively. So you want to know they spent their own money, which supposedly, if this data is correct and the form 4s are correct, which is what they've done. So, what was it, 1.2 million? That's not bad at the end of the day. But yes, stocks, Coty stock plunges over 20% after cosmetic maker reports surprise loss. So is that mentioned on here? Yes, here you go. So the revenue, according to TradingView, beat, but the earnings didn't. I don't really know what was expected. I suppose we should read the article and see. 22% after cosmetics makers posted surprise loss and gave weak guidance as retailers pull back on orders. Yeah, which is what we're saying. The economy is. I just don't think it's something that does well in times of economic pressure. Net income of 37.6, profit of 0.1 cent a share. Revenue fell 8% year over year. Yeah. Broader macroeconomic and tariff uncertainty is fueling cautious retailer ordering, potentially, but I just think that the overall, tariffs aside, I don't think the overall economy is good enough for people to be comfortable spending, on luxury items at the moment, but that's just my opinion. So quarterly like-for-like sales sunk. Said that, how do you go forward with this? They're saying that they don't think things is going to get too much worse. Things are going to get too much worse. Sound like a Londoner then. They don't think that things are going to get too much worse. 6 to 8%, 3 to 5%, and then back to positive growth again. So what are you saying there? Drop the revenues by 10-15%. I want to know actually if they've given earnings guidance, because that's revenue guidance. You've mentioned revenue guidance. What about earnings guidance? They commit to anything like that? They do not provide an explicit forward-looking earnings per share forecast, so in itself, I guess, is not entirely positive. Which makes doing any sort of like forward analysis even more difficult, because, like I said, it's so lumpy. We go to 7-year free cash flow margin there at 2.7, 3-year at 4.4. Well, that's literally where we're at. Literally where we're at now, and they're saying things are going to get worse. Things is, why have I started saying that? I'm not a bloody Londoner. Things are going to get worse. So to say that, oh yeah, it's going to be 4.4, knowing that they're saying things is, I said it again, things are going to get worse, I think is ridiculous. I don't think that's a conservative valuation front at all to do that. 10% loss, what would it be, 500 million? Like, I think you've got to go for worse than that in the current climate. What would you say, 4.8, 4? But then this 3-year free cash flow margin, what are we going to use of that? Like 80% seems huge, doesn't it? I do think that because of the brands, 10% multiple, this is for the Monies per buy, sell it in the nth year, so for a multiple of the, what's it called? I don't think the 10 is too bad considering the brands that they own. I know when you actually look at it historically, it's higher, significantly higher. I mean, 13, 12, you could maybe go to 12, but it's not conservative if you're using numbers that are that high. The biggest problem with going forward is doing the margins, 3-year operating margin of 7%, but they think it's going to get worse, so where would 7% be? Like, you go to the last period of distress and they were negative. COVID, they were negative. Simple free cash flow negative. If you're a value investor, you got to go conservative. You have to go conservative with any assumptions. And I just think that 8% is 80% of using that is too high, considering they're saying that. It's a very difficult one, right? Because they're saying that the majority of their business is high margin, which is obviously good because that would help keep these margins potentially in positive territory. But the what have we got there? Yeah, 20%. The to choose is just very difficult on my experience level. If they're saying that their revenues are going to go down, so for next year, so this is an assumption of revenues on a multiple basis for next year. It doesn't look good, if you were to drop it that much, they'd end up losing money because the interest expense would be higher than what the EBIT would be. So it's a very difficult one for me to value. And if anybody actually watches this far into the video and you can give me guidance on how you do something that's this lumpy, it'd be very much appreciated, to be honest, because this is like my inexperience in full flow here, Bride's valuation would say that it's overvalued, but then am I being way too conservative on the percentage that I'm actually using? I just don't think it's going to make things significantly better if you were to put it back to the 80%. And I think that it's not overly conservative to use that. And as they haven't given any earnings guidance, it's very difficult for you to come up with a figure on your own. It doesn't overly improve things. The only benefit that they've got is that the brands that they've got are, as much as I don't like intangible assets, the brands that they've got are worth something. So I don't really know what I could value this at, to be honest, because any revenue pressure or margin pressure and their interest expense is 600,000 away from swallowing up their free cash flow, and then you're eating into cash, of which we've said that there's not a significant amount, especially if they're gonna do some refinancing or some asset sales coming up. This is certainly a company that is, at least in my mind, in between a bit of a rock and a hard place at the moment, in that things could get worse, but they've definitely got safety nets. And if you do you gamble on the safety nets? It's not really investing if you're gambling, is it? You can pick up a dollar's worth of revenue for 64 cents currently. That's just on the market cap, though. You're paying $1.32 for a dollar's worth of revenue based on when you bring the debt into it, which means effectively there's probably far better investments out there. But the technical upside on this, when you see where it has been, historically, even if you get down to like the post-COVID struggle. Oh, sorry, wrong thing. Get down to like the post-COVID struggles. There's definitely, room for this. And should they do their refinancing or their asset sale, or let's say the only problem with asset sales is you're going to lose revenues as well, or at least portions of revenues, because they didn't sell all of Weller, did they? When was this? Last year and a bit ago, it was trading 200% higher than where it currently is. Very difficult one. This, in my mind at least, would be pure speculation based on the just seeing if there was a channel in there, but it wasn't really an effective one. It would be based on pure speculation that things are going to get better, when Coty themselves are financially saying that earnings wise they're effectively saying things may or may not get better. It looks like they're leaning towards, for this year, at least for the next 12 months, they're potentially not going to get better. But within 6 months, less than 6 months, we're going to find out what's going to happen with the debt, and that can change things significantly. If they can refinance under some generally favourable terms, or they decide to do another big asset sale. Because that is one thing I will say, right? If we look at the and where is it? How far? Down here. Just need to try and find the find the section. If we're saying that they spent 7.5 on a basket of brands, and then they sold 60% of one of them for 4.3 billion. 4.3 billion, at that point, considering you've got Max Factor and Claro, heard of that one as well. Don't know how to pronounce it, because it's, like I said, it's not my cup of tea, this sort of line of business. But 60% of one of them's paid for over half of what you did there. So it's how you determine whether or not it was a good investment or not, really. You've picked up, like I said, 4 brands and sold 60% of one for over half of what you paid for those in 4 brands. So in one sense, it seems really bad. They were literally, within 4 years, they've had to sell off some of it, which to me is like, you've made a bad acquisition. But on the flip side, that bad acquisition gave you 4.3 billion from 60% of one of the brands, So it really depends. Like I said, adjusted earnings per share, no specific guidance provided in Q4 release, which is unfortunate. Might be interesting to see what Seeking Alpha's got on it. Saying hold. That's a very recent one, actually. It could be worth reading. The discount is getting crazy. I read this one earlier. I don't believe there was an awful lot mentioned about the debt in it, which is surprising to me, at least considering it's unaffordable, unless because they've historically done it over and over again. Just the general assumption is that, oh, don't worry about the debt, which is, you know, for me, ludicrous way to stand. But, you know, the market is a, you know, voting machine of the masses. It doesn't, you know, as a value investor, everything that I've read, and you're going to be standing in the wilderness by yourself for a long time before anybody else agrees with you. Weak guidance suggests continued near-term weakness despite the stock being deeply oversold. See, I mean, compared to where it was, it does look, you know, it does look cheap, but that's just on a purely on a price basis. When you look into the finances and the debt and all that, does it look cheap? I don't know. You know, when you look at the overall macroeconomics, does it look cheap? Because you're in a business that people currently can't afford. You know, long-term upside. This is the thing. Long-term upsides exist, and that I would agree with. In that we are in a period of stress. The company is in a period of stress. Isn't going to last forever, you know, like it's like with the Crocs analysis that I did, where I said, like, if you start to stress test it, it becomes lumpy, but then the stress test is effectively the one-off test, you know. It's not normal, you know what I'm saying? But then the normalization of Coty is difficult for me on my experience level. Strong market position, agreed. Patents, okay, and takeover potential. So this is another thing that I read actually in the other article, is that it's potentially ripe for a takeover because it's quite cheap and the brands that you're getting are quite significant. So I can see that angle. I prefer to wait for another quarter of results or signs of insider buying before accumulating. Now, there was signs of insider buying. We've had 1.2 million of insider. CEO, CFO. The CFO one's a bit disappointing, to be honest. 60 grand. It's not amazing, is it? The CEO for $1 million, however, is pretty good. So, in a second, or should we do it while I'm thinking about it? What I want to know. When was the last time they put one of them out? Not. Here we go. 2024, end of 2024. What percentage of the insiders own what? Beneficial already in there. Looks like I've done it before. Get down to the. Hopefully, there's a table somewhere. Is this it? So, 52% is owned by this Jab Beauty. I don't actually know who they are. I'll have to look them up. All named executives, 6%. It's not great. It's not great. It is what it is, though. I've seen a lot worse in companies. In, you know, a few of the ones that we brought up have been miles worse. So 6% is not great, but it's not terrible. This is significant, though, in that they own 52% of the company. And they are mentioned here. Yes, 100% of their portfolio. So are they invested? You bet they're invested. You know, do they want the company to have the best possible outcomes? You bet they do. I don't know who these are. Never heard of them. But there's no other significant funds I've actually heard of that are. Not that I'd heard of these, but this is significant. You know. Ownership, 5% BlackRock, Vanguard, so the usual. Okay, nothing unusual about that. But no funds that I respect appear to be. Oh, Gotham is in it. Now, the only thing with this is that it's so small. It's most likely one of their, heavily diversified ownerships, you know, which is unfortunate. But Gotham, at least from information I can glean, don't seem to run it like they did when Greenblatt was getting the 50%, you know, a year returns anymore, which is a shame, because it would be nice to find some hedge funds like that you can copy, well, not copy, but you can see their holdings, you know. Gotham doesn't seem to run like that anymore, which is unfortunate. It is what it is. So I wrote an article stating I was watching Coty shares as well as that come in, trading at around 460. I gave it a hold rating, okay. Fairly narrow trading range between 4 and 5. Seemed to offer some hope the stock had bottomed, but that wasn't the case, was it? Because it was down to 3 something. Potential positive push in the stock being deeply oversold. So what they're using there, an RSI to get that? I don't know. That's MACD there. But, as you can see, trading volume was massive at just over 44.6 million shares. This was about double the already a very high volume the stock had. Okay, is there anything? This is the biggest problem. I want people to talk about the debt. I want people to talk about what they believe the earnings to be, and I want people to talk about the debt, but nobody seems bothered by the debt. Sales are soft in the United States. Dealers were reducing inventories, which negatively impacted that's another thing actually. Let's look at the working capital analysis and how much that is being manipulated. Wow. Payables are being held for over 100 days more, 30% increase. Now that manipulates cash flow. Inventory's hanging around longer, and it's taking them a lot longer to collect. Every single one of those is a red flag. 50% increase in payables, inventory hanging around longer, taking, 30% longer to collect. Every single one of those is a red flag, unfortunately. But then I guess this is a company under stress. Could things get better? Yeah, that's the way you got to look at it, I suppose. That's how Monish Pabrai would look at it anyway, So, some of these big positives. Coty is the third largest company in the prestige fragrances market. Okay, yeah, that's a big deal. I believe this alone could make its potential takeover target. There's a lot of people talking about takeovers, but I haven't seen any news on that other than speculation, Management credibility is an issue for me. Management should not be blamed for the high level of tariffs. That's true. I also see, however, I'm not blaming management for these issues. I also feel like they need to prove themselves because I do believe there's potential credibility due to recently weaker than expected financial results. I'd also feel better by believing in a potential turnaround if I see management buying this stock, which they've done. Maybe they read your article. Just based on management guidance alone, it seems weak. The results are likely to continue for at least the next quarter or two. I'm concerned about potential slowdown in the economy, same, due to some recent weakness in the jobs market. I also believe that tariffs could start to more fully and negatively impact many companies. Discussed company has about $4 billion in debt, which is significant. However, I also own a stake in Weller, which is valued at around $1 billion. And this could be act as a partial offset to this debt load. So yeah, so what he's saying then is potentially what I believe he's saying is that he potentially could see the whole entirety of Weller raising a bit more money, with the stock being oversold and the share volume indicating a capitulation-like event. I'm not opposed to buying a very small position in this stock just to watch it more closely. Recent financial guidance indicating weakness is expected to continue. This stock might continue to languish for the rest of this year. For this reason, I continue to see it as a hold. Impacted by tax loss selling this year, it makes sense to consider waiting a bit until we can. Yeah. Okay. Any comments? Great to see the insider buying this article was hoping for. It was always good, but not sure it was worth 3% stocking. That's when was that? Yesterday, 2 days ago, because it's almost 1:30 in the morning now, so I actually better go to bed in a minute. Has very bad capital allocation. This is what I believe. Destroyed 1 to 1.5 billion in capital allocated to influencers. Really, stock incentives only for CEO. preferred stocks a jab with no dividend but cash payments, penalties for price drops. Wow. Be interesting to find out where he gets this information from, actually, because this is true. It's not great, is it? Mass beauty business is horrible and high competitive environment with no price power. In my opinion, it's fairly valued now. Price below 3 can be interesting when the capital allocation dictated by jab is a concern for long-term success. There'll be plenty of cheap companies to consider. Yeah, I mean, don't know the veracity of some of these things that he's saying, but this, fairly valued now, probably agree. You know, what we would do is we would leave this page. If I am going to go to bed now, and I'll probably restart this video tomorrow, but yeah, we'll look into those things, because if they're true, then that's not good in itself, is it? That goes even more towards the bad management angle that, you know, I was saying. I have to be honest, so I don't know that it's even remotely the same management as what it was 8 years ago, but to go from buying a company to having to sell it within 4 years is an admittance that you were wrong to me. There we go. All right, so I'm going to pause the video here and then we'll get back to it. And actually, I want to look up into this. This is actually quite interesting, what he's stating here. So I'll look into that for a little bit, and then that's where we'll go. But so, as far as you're aware, nothing's going to happen. It's going to come back to the same video. As far as I'm aware, it's going to be like 24 hours later before we come back to it. So I'll see you in a bit. Right, so we are back on this fella's comments here. We said we were going to look into them, about stock incentives, preferred stocks, and just see where this man was coming from with this. Because obviously he's staying now, it's fairly valued now. Which, to be honest, to me, it sort of looks that way, but I wanted to just dig in more into some of the stuff that he was saying. I've used ChatGPT AI again for that. So let's just see, because I've already asked. There we go. So he's mentioned about stock incentives to the CEO, and he's not incorrect at all. There are significant stock incentives to the CEO. Some of them are performance-based, which is these ones down here. But overall, say all of these performance-based ones were vested, it actually turns out that the shareholder dilution, where is it, would work out at around 5%, which, you know, is not an insignificant amount. Now, it's not even really been offset by the look of it. In, like, sometimes if a company was to, you know, offer significant incentives, you know, in stock, then they would potentially try and offset it. But further down here somewhere, it states that they've only diluted, so they've got about 5% dilution from, if all of these performance ones were vested and the goals are met, but they've only actually bought back around 1.42%, so it doesn't cover the dilution that they're causing. If we actually look at the share count, it has risen reasonably significantly since 2018. You know, well over around about 150 million shares, which is no small feat, and obviously that is significantly impacting the equity owned by the shareholder. Like, I personally don't like to see that. It's not the only thing that's obviously impacted it, because obviously they've taken on more debt and all that as well, but it's not a great thing. It doesn't really show somebody who's shareholder friendly, not in my opinion anyway. So a bit further down, what did I ask next? So they said, would you like me to estimate how the dilution affects net income, which doesn't seem like a lot. Okay, 57 down to 55. I know it seems trivial, but in the scheme of things, you know, it's still not overly shareholder friendly, you know. So what else do we say? What are the penalties? So he then goes on to say, yes, preferred stocks are jab with no dividends but cash payments for penalties if the price drops. Now, I haven't been able to find anything on that. We had to go down into So it does impose certain restrictions, limited on share transfers and additional purchases, but doesn't appear to include any financial penalties for breaching those covenants. Now, it doesn't mean that guy's wrong. If you're a conservative investor, you should probably assume that there's some truth to it, but AI has not been able to find any truth on that. So, yes, Coty holds potential liabilities linked to JAB, notably the lease guarantee, but there are no explicit monetary penalties laid out. So that's potentially something. And then I said about the preferred held, specifically by JAB, because this sort of went on a bit of a loose tangent to the outside of the question. So Series B was not held by JAB. It was held by KKR, which bought 60% in Weller. Now, they paid them a 9% dividend, which could have set up to 12%. Now, I believe I am correct in stating that they have actually, KKR have converted all of their stock into Class A common. It's this man here who still holds the Series B preferred, which is why they're still on the balance sheet. So it says JAB doesn't hold any preferred. Where are we now? So Series B preferred are exclusively tied to the KKR and HFS, not JAB. JAB's influence comes to majority common share ownership, not preferred equity or special dividend arrangements. So I asked, why did they issue preferred to KKR? Because KKR also bought 60% of Weller, so there was obviously more to that deal. Coty announced that KKR had two main parts. They've given 750 million convertible preferred, which ended up being $1 billion later. They carried a 9% dividend, which we've already covered. But for Coty, this provided fresh capital at a time when its balance sheet was stretched, and KKR got board representation, 2 seats. The preferred deal was structured in KKR equity exposure and upside, while injecting badly needed liquidity into Coty. So what we're ultimately seeing is that they've had some pretty bad management, at least in my opinion. We said that, like, you've bought all Procter and Gamble stuff, and then within 4 years you've had to sell a significant portion of it, and potentially, according to this, it could be one of the best things that they owned. Where did I read that? At 6%, they obviously sold a 60% stake to Weller. Coty remained 40% and used the proceeds to pay down debt. Now, KKR obviously benefited because they got control of Weller, so they're saying it's a strong cash flow professional hair care asset. So, unfortunately for Coty, they've lost the majority ownership of something that's supposedly a strong earner because they took on too much debt. Raised $1 billion in capital from KKR, monetized part of the Weller for $2.5 billion in cash proceeds, kept a minority stake in Weller for future upside to reduce debt leverage. So I personally don't think you can see that as anything other than bad management, but there we are. I haven't got a lot of experience, so that could just be, me being overly harsh, but I'm a value investor. I want value for my money. Preferred shares are less dilutive up front, so the only problem is they're less dilutive up front. Conversion only happens if KKR chooses. Well, KKR says KKR did choose and vested all of them. So let's see where it says that. Converted in 2021, they converted into 50 million Class A shares. And then sold an additional 9% stake in Weller to KKR. In return, Coty redeemed half KKR's remaining convertible shares, equivalent to about 47 million common shares. So in November 2021, again, they converted more. So they've converted like 100 million shares, which is obviously significantly dilutive to the shareholders. On top of that, you've now got the potential 5% dilution from the CEO's shareholdings. To me, that's not great at all. 1.5, 150 million shares, over 150 million shares. It ain't You know, there you go, 9%. So 9.2% share increase is very shareholder unfriendly, I think. And whether or not they've been forced to be like that is negligible in my opinion, in that they've messed up and they've diluted the shareholders because of their mistakes, and that isn't really something that I'm, you know, overly thrilled to read about, to be honest. It doesn't, to me, that doesn't show shareholder friendly attitude, but there we go. I asked why there's still, if KKR converted and redeemed all of their Series B, why have they still got Series B on the balance sheet, which we can see. We got on the balance sheet. Obviously, this is here as the notes on the Series B, preferred B and preferred A. So all the preferred A, I believe, are gone. On the balance sheet, down here, preferred B. There you go, preferred Series B. There's still some left now. That is owed to the other person, this Peter Harf's entity, not KKR. So KKR did eventually convert all of theirs, but this man has not converted yet, which is why they're still on the balance sheet. So at that point, unfortunately, I ran out of my questions because I'd been asking a few questions throughout the course of the day while I was at work. So a significant portion of these comments are true. And yes, I would also agree with this. You know, there's a lot of different, you know, it's a highly competitive environment. There are a lot of different big brands, you know, vying for the same thing. What else did I ask for? Let's see. So I unfortunately had to move away from ChatGPT and I've moved to Google. So one of the other questions I wanted to know was what the hell was Jab Holdings, because I'd heard of it. I'd seen it on other Whale Wisdom stuff before. But obviously, it's got must-have subsidiaries because this is Jab Beauty, which is not the same as Jab Holdings, but they are the same entity. So I asked what Jab was, and apparently they're owned by a German family, the Ryman family, who have been wealthy for a long time. Let's put it that way. They own significant stakes in Dr. Pepper. I don't know who these ones are. I got to be honest, I'm not American. Pret Manger, Krispy Kreme. Obviously, they own Coty, Weller. I'm guessing that Weller is through Coty, unless KKR is also owned by Jab. We'll have to look into that, actually. I can't imagine that it is. I've not seen that written anywhere else since. So I asked for a list of Jabs and its subsidiaries, because obviously Jab Beauty is a subsidiary of Jab Holdings. And because one of the things that's been mentioned about the debt is that the bond prices hold up because people believe that Jab is going to step in and help them again, as they have done in the past, and they'll refinance because they've got all this back in. Well, sorry, wrong one. You can see here Jab's got a serious amount of money, so I can understand why people would believe that they would step in again. Obviously, being a majority owner, needing to. 31.8 billion. Jab's portfolio is described as being 60% in publicly listed assets and 40% in privately held assets. So I asked, obviously, then, well, because everybody's just assuming that Jab is going to step in and help them, because there's no way that they're going to pay this off. They're going to have to refinance, or they're going to have to get a cash injection from somewhere, which historically there's not a cash injection, it's a shareholder dilution by the look of it, so that's not great either. But I said, like, how committed is Jab? Well, apparently Jab has been in the company for a long time, and apparently they've demonstrated significant long-term investment. And it does say Jab has been investing in Coty for almost 3 decades and stated they expect to remain so. So they've got the capital. They definitely have the capital behind them to help refinance. And if they are going to step in and help, then I can perfectly understand why these bonds are trading so close to par when they're sub-grade bonds, you know. So from that point of view, it seems like there's not a lot to worry about in regards to the company having any imminent plans to disappear off the face of the earth. We're talking about Coty there. You know, if Jab's going to continue to prop Coty up, then it seems likely that is the case. Nothing's ever certain, but it seems likely that is the case. It's also important to note that Coty has faced challenges and controversies. So there have been instances of shareholder litigation where courts ruled that Jab and Coty's board breached fiduciary duties by approving a tender offer that was deemed coercive. This highlights potential for governance weakness and conflicts of interest. Yeah, not surprised. It doesn't. Sorry, just punched the microphone then. It doesn't sound like an overly, great company, to be honest. It doesn't sound like it's well run. It doesn't sound like you can trust them to be shareholder friendly to anyone other than a select few. That's the way it seems anyway, but Jab has demonstrated a strong commitment to Coty for increased ownership, long-term investment statements, and support for strategic initiatives aimed at improving the company's performance. So mainly to improve the company's performance, they're going to have to cut down on debt, because as I've shown here, my version of simple free cash flow, which is operating earnings minus capex, and I take away stock-based compensation and a couple one-time gains and all that sort of thing as well, is that they're barely treading water on being able to pay their interest expense, barely. And they're gonna need help with getting rid of this debt. But if they could get rid of a significant portion of this debt, then obviously, fortunately, they get rid of 100 million, and 100 million actually goes straight into simple free cash flow, potentially. So yes, there's that side of things. Honestly, though, I feel like it doesn't seem like it's going to go anywhere, does it? It seems like they are, as the bond market's prices prove, or at least show, that they're here to stay, at least for now. They have a big ass backer, that has stated that they have no intention of going anywhere, and they want to help turn the company around. I don't know. It's not something that I'm overly comfortable with in the way that the company's been ran. Doesn't mean that it couldn't be a good investment, because obviously it's trading reasonably in the gutter compared to where it was historically. But there needs to be significant improvements, and the debt and getting rid of the interest expense is going to be huge. Yeah. Where is... So, tangible book value is minus 3.3 billion. So, total assets minus total liabilities minus goodwill and intangible assets. Well, goodwill and intangible assets is huge. 7 billion is bloody big, well over half of the total assets. Now, as I said before, I don't like the value of intangible assets because they're not tangible, but there is value in brand names. There has to be value in brand names, So, as this is reasonably consistent, although there has been quite a few write-downs, actually. Look at this, 16 billion in goodwill in 2017. So it has been written down, which obviously is not a good thing for the book value, but for the tangible side of things, it gives you a better idea of what the actual tangible value of the company is. This is then your problem. Then no, is the total debt. The level of total debt needs to decline, otherwise your tangible book value is going to remain negative. Yeah, I just don't really know what to make of this one, to be honest. There's a lot I don't like. Let's put it that way. There's a lot I don't like, but there's also, if a turnaround is completed and they do have the backing of the holders that they claim to have, then there's also potential for upside here. Now, I think personally that upside is speculative, and as an investor, I'm not a speculator. Now, is it more likely than not that they will potentially turn it around in the end with the so-called backing that they've got, then yes, like Monish Pabrai puts probabilities to his investments on what he thinks the outcomes are going to be. I would say it's reasonably, you can be reasonably confident that it would, you're going to get through the maturities of the debt refinancing, but historically I can't see it coming without a cost to a shareholder in another way, because the shareholder dilution is, significant. My takeaway is that it's not a shareholder friendly company. That is my takeaway. It has been badly managed. I don't think anybody can dispute that it has been badly managed to take on what they've taken on and then have to sell portions of it. And, yeah, if you were to invest in this one, I think it would be highly speculative. I think if you were to lay out your percentages of what is likely to happen, is the company likely to be around? I would say yes, it's likely to be around. They're big brands. Their backer in Jab Holdings is seemingly very committed. Doesn't mean they'll be committed forever though. But this company's got problems. It's got serious problems. The debt and the shareholder dilution, to me, I don't know. It's not unforgivable because there is upside here, but I think you're going to have to wait for it. I don't think it's coming, anytime soon. As far as an investment comes, you might get a lucky pop in the stock price when refinancing gets announced, which I'd imagine is pretty soon. Going to be pretty soon because it's due early 2026, so there's going to be news on that reasonably soon. We're coming towards the end of 2025. So you might get some pops in price based on that, but that's not investing, is it? That's just pure speculation, and that is not what I am here for. I am here to learn to invest, and, there's no, outside of this Jab Holdings, there's no serious investors that I am familiar with their funds, let's put it that way, other than Gotham. Obviously, definitely serious. Joel Greenblatts, one of the best value investors of all time. So definitely serious. But the size of their position, percent of their portfolio, that is literally just most likely a, they've built an index effectively, and this is just a small portion of it. So that is not to me old school Gotham where, you think, blimmin' out, Joel Greenblatt could be on the summit here. This is just, we own it because it's part of our huge portfolio that's, reflecting the S&P 500 or the market or whatever. So yeah, that's where I'm going to leave this video at. Obviously, you're going to have to make up your own mind on that, but I am not enthralled with the management, but I am not against the idea that there could be significant upside in this if they were to turn things around. If they were to turn things around, then yes, I can see it. You could be waiting a long time. I think you're going to get pops when refinancing news comes up, but until they can actually get rid of that debt and they stop diluting shareholders, I think that this is not a shareholder-friendly company to be in. That is my opinion. Obviously, anybody has any other opinions and you made it all the way through this video to this point, please let me know. But it's a very interesting one from my point of view, like doing these deeper, I wouldn't say it's a deep dive, but doing these deeper dives on companies, because it's helping me and my learning experience, and hopefully if anybody else is trying to learn and they are watching these videos, it's helping their learning experience too, because that's the whole point of this. But yeah, not shareholder friendly, diluting the shareholder, too much debt, but probably sticking around, almost certainly sticking around. But it could be a long time before they turn things around. So what was it? Well, how much debt was coming due? Let's have a look quickly. It was a significant amount, wasn't it? Like 1.2 billion or something like that. Yeah, there you go. 1.2 billion just next year. And then after that, a further 600 million. And then a year after that, a further 600 million. So the hits are just going to keep on coming, and currently their free cash flows cannot afford any of it. So it's refinancing or, you know, equity dilution, and it ain't great. And the Z double prime or the Altman Z score is also very unsure on the outcome of this. Now, yeah, there we go. Right, so I'm going to finish this video here. If you've got this far, thank you very much. Please like and subscribe, and certainly if you have any opinions, please don't be afraid to put them across in the comments. You know, I am here to learn, and if you know more than me and you want to say something, please do, because I am more than happy to listen to other people that could point me in the right direction on my journey. So there we are. All right, well, thank you very much, and I will see you on the next one.